All right, guys, we're going to talk about what we're doing Whiteboard Wednesday tonight. I'm trying to get this all lined up. So I'm in my daughter's room, and this is going to be a little different than usual. Again, we're moving, okay? So we're moving, so cut me some slack. I'm going to have a official setup here soon when we get to Dallas. But let's talk about this, guys. So let me get this, make sure that looks good. Looks like it's good to me. I think you guys can see everything. Feel free to comment in the comment box below, guys, or question mark box. But let's get started. Let's talk about what should I invest in. I get this comment and question all the time. Let me grab my marker and get going. All right, so I hear this question quite a bit. I was feeling real spicy today. And so I decided on the treadmill at the gym in the morning, I was like, I'm going to write up a thread. I'm going to write up a quick thread on if somebody asked me this question, how would I actually explain this? Obviously, somebody comes to my DM and they ask me this question, and I'm like, guys, I can't answer that question. For one, it's illegal. I can't actually tell you what to invest in legally, so it's an obvious number one. But number two is like I don't have an answer. Like there's no such answer right away off the bat, okay? So when somebody comes to me and says this question, my mind goes to thread form that I had today on Twitter. If you guys follow me on Twitter, you saw that long thread about kind of what this whole whiteboard thing is about tonight. So the way I think about this, guys, is a long-winded way. It's kind of like when somebody asks you a very surface-level question. You're like, well, that's a really loaded question. There's a lot to that. So I'm going to break it down step by step of how I think about it and ultimately get you to an answer, okay? So before we actually, like I say before, very, very broad in the very center of it, let's dive in and let's just set the stage. Let's understand like kind of the how we get to the actual investment itself. So I'm going to start with number one, broker or platform. We all know that we have to select an actual broker, the gatekeeper of our money. They literally hold our money. This could be up here. I have Vanguard. I love Vanguard, so I put a little smiley face by them with a little star. That's who I use. That's not right or wrong. These aren't right or wrong by any means. That's another thing, in a kind of a something important to note is like, none of this is right or wrong. It's just like what somebody does based on their preferences, based on their needs, and based on a lot of other factors, okay? So for me, I started with Vanguard. I love Vanguard. They're very reputable. They're very respectable, and I use Vanguard. My brother works at Fidelity, though, and he uses Fidelity. And so Fidelity is a phenomenal company as well. Charles Schwab is a phenomenal company as well. These are three popular brokers or platforms that I highly recommend. I really, really like these. That's not investment advice by any means. It's just a broker that you'd work with. I listed some down here. And so I listed these blue obviously up here and then black down here. So a lot of people come to me and say they have TD Ameritrade, but they're investing. Technically speaking, yes, that's fine. But listen, this is called trade. This is called trade. Those are platforms, not brokerage houses, for trading in particular. That's what the platforms are built to trade. So I kind of stay away from these when I'm talking about investing. I typically don't look at those at all. Robinhood, let me throw up in my mouth. I'm not going to even talk about that. So just big no-no or whatever. And you guys can ask all the questions you want first, so I'll get to the questions. But Robinhood sucks, and Robinhood is something I would never touch. And so M1 Finance is a phenomenal app, but it's an app. It's not really like a Vanguard. It doesn't have its own funds per se, right? Vanguard's has its own funds. Fidelity has its own funds. Charles Schwab has its own funds, which we'll get to in number 3 below. M1 Finance, from what I know, is pretty respectable. I don't use it, but it's a solid app out there. I guess I'll give it a check mark because I think they're somewhat respectable from what I've heard. A lot of friends use them. The FI couple, Josh and Allie, use them, and they love it, okay? So, number 2, once we select the Vanguards, Charles Schwab, Fidelities of the world, we have to go to step 2, which is account type. And account type is obviously a huge question mark because this is where tax diversification and strategy comes into play. These are 6- and 7-figure decisions. Let me repeat, these are 6- and 7-figure decisions. So I had people coming to me just recklessly throwing money in a taxable brokerage, 100% of their money. I'm not going to invest for retirement. I have also the other side of the spectrum that says I'm going to throw every dollar I have into the traditional 401k because my grandma told me this is the best investment ever. Let me tell you this, is a good, healthy mix of a lot of different accounts accumulated together are going to be the best possible outcome for you likely as an individual. Everyone's situation is going to look different, of course. as far as which accounts you go through and which tax strategy that you use or diversification method that you use to therefore accomplish your goals. There's a lot that goes into that question. And so when somebody says, should I max out my 401k? Should I max out my IRA? Should I, put a bunch of money into my brokerage account? That's really hard unless I know your goals. I need to know your goals. I need to know your risk tolerance. I need to know a lot of different questions. And I'll ask you a million questions. Anybody that's been on my academy calls, Budget Dog Academy calls, you guys know how many questions I ask to see if I can even help you in general. It's because this is a nuanced topic and this is very specified to an individual. And if they don't ask the questions, if a professional's not asking questions, you need to go to somebody else. It's a red flag if they don't. I get a lot of people coming to me and saying, hey man, what stock should I pick? I say, I have no idea. I refer them to a post, I refer them to a YouTube video, and they go to the next financial professional and they say, or I'm not even going to call them professionals. They're not CPAs or CFAs or anything like that. They're online Instagram accounts. That's what they are. They have zero certifications, zero anything, right? And those individuals might give out a stock pick, and that's a huge red flag. So be my guest and take their stock picks, or be smart and use your brain. So we have a few things right here. We have IRA, 529, HSA, 401k, 403b, 457b, taxable brokerage, UGMA or UMA. So all of those are options. It's not limited to just those. Those are very popular options most of you guys have heard of or are probably dealing with. Now, when it comes to the 401k, 403b, and 457b, let's go back up to number one. Is when you have a 401k, that is through Emwork. That is an employer-sponsored plan. That means that you don't select the accounts, you don't select the broker and platform. So you don't get to select these guys. If your 401k is with Fidelity, your company has decided. What this means, and this is very important distinction and understanding, is that your company said, hey, Fidelity, give us a bucket of funds, maybe at the number 3 level. Give us a bucket of investment funds, maybe 20, maybe 30. We're going to give this to our employees as a benefit in the form of a 401k. The employee comes into the company says, here's your 401k. The 401k is not held through your company. The 401k is held through the broker or platform, which are one of these guys typically. Now, it could be a principal. There's other ones, obviously, than these. And likely you probably have somebody different than this. When I was at Deloitte, I was there for 6 years, right? I used Vanguard. So Deloitte has top of the top. A lot of 401ks suck. I'm not going to get into that conversation too much tonight, but 401ks can suck. You got to be very, very careful what your 401k is in. The bigger the company, generally, the more optionality that you're going to have, because that means the bigger company is going to spend those dollars to buy a better plan than some of the crap that smaller companies have. My wife's old job, not a big fan. She used Principal. Her company bought Principal, and I wasn't a big fan. It kind of sucked. A lot of high fees. Every fund, I think, was above 1%, just garbage stuff. Anyways, so you can select the actual account. Now, this is a big conversation, guys. Number 2 is a huge conversation. This is where you kind of set the stage from a goal perspective, what you're trying to accomplish, how many dollars of yours of investable assets or free cash flow per month are going to go to these various accounts, and then how is that going to stack up against your goals long term? And that's a big question. Number 2 is a long conversation. This is not just a real quick, hey, I want a 401k, I want an IRA. You have to map out each one, and then also you need to figure out how much is going into that. Am I putting $500? Am I putting $1,500? If I have $3,000 available, do I put all $3,000 in this account? Do I put $2,500 here, $500 here, $250 here? I don't know. There's so many different questions you have to ask yourself, and you need to meet with a professional if you don't know these answers, because this is what happens. I'll show you an example right now. So, let's say Johnny Boy he goes out there and his grandma's like, hey, yeah, Johnny, you started your job, you have a 401k, you really need to max that baby out. And all he has is, let's just say, $20,500 a given year. And for, let's say, 30, 40 years, he's like, Grandma told me to max this 401k out. Traditional 401k, I have another whiteboard Wednesday on traditional versus Roth. He does a traditional 401k, and he gets to 65. And at 65, he's like, man, I'm retiring. My grandma's right. I have a lot of money in this 401k. Well, he doesn't understand of how the tax game works. And because he didn't use diversification, he didn't use any strategy along the lines of his investment accounts, he gets to 65 and he has 7 years until RMDs hit. RMDs are very, very heavy. And also regular income tax. So when he withdraws that money, he has no flexibility or optionality of maybe I should pull from pre-tax, post-tax, and taxable, the three buckets I talk about quite often. Instead, he only has one bucket filled, and now he's pigeonholed between the IRS and his 65-year-old date. Well, good luck trying to beat the IRS. So if you don't have a strategy of which accounts to use, how much to use, and which buckets to fill appropriately and aligned with your goals, you're going to struggle. Even if you do really well, you're going to be suboptimal. We don't want suboptimal results. If you follow me, guys, you guys get great results, and you guys should get great results every single time if you just follow the stuff I talk about all the time. Have this locked in, set it up, educate yourself, and actually do it from a practical standpoint or a do-it perspective, and you will dominate your finances long-term. You will become multimillionaires, and you will know the tax game inside and out, and you will optimize your financial life. So that is a little bit on tax diversification strategy. That's obviously a big conversation, guys. However, so let's say that guy does go to the 401k, he has a bunch of money. He's going to get taxed at the wazoo for his 401k, traditional 401k. And therefore, he's going to lose a lot more money than somebody that said, hey, instead of maxing out that 401k, maybe I thought about putting some in my taxable. I maxed out a Roth IRA instead of a traditional IRA. So I did maybe a little bit in pre-tax, a little bit in I maxed out my Roth IRA, and then I put some in my taxable. I also aligned the strategies within that for my goals that were in particular my goals, not my neighbors, not my friends, and not my families. And that's how you guys really maximize that. So obviously you can see the buckets, guys. So pre-tax bucket in really short, general high level, you're going to deal with regular income tax essentially and RMDs, required minimum distributions. Post-tax, like a Roth IRA or some sort of that, like that, $0. That's the beauty of it. You pay the tax on the way in. So there is tax associated, obviously, on the way in, but then it grows tax-free, and at the end, there is $0 from a tax perspective. So you paid it up front, and you have a lot of flexibility down the line. And then taxable, you have up to capital gains. However, if you have looked at the tax brackets or tax rates, for 2023, I believe it's up to $83,400 or roughly around that number. If you're married filing jointly, able to pay 0% capital gains. This is a huge conversation. It might be the difference between 6 and 7 figure differences down the line, and it starts now, because the thing is you can't change that when you're 20 years in. If you haven't started today, if you don't know this today, you need to know today. This is not something you push to later, because it's going to be too late. When you take that money from pre-tax, and let's say you start rolling it over with maybe a Roth conversion ladder or something along the lines of that, and you're taking that money, moving it to Roth dollars, or you're just taking it out and using it, you now have zero flexibility, and you have to bite the bullet and pay the bill. Because you didn't plan ahead of time. This is all a planning exercise. This is not I talked to my students today about this. You got to be proactive. You cannot be reactive. If you are reactive, you are screwed from a tax standpoint. Okay, so the other last thing I want to say is you have to select your investments, guys, in all of these accounts, but especially the 401k. I can't tell you how many times people say, yeah, I'm invested in my work's 401k. Either they assume that their work is taking care of that, or like the platform or broker they work with is taking care of that for them. That's not really the case. It's going to put you in probably a target date fund, which is a very suboptimal choice, and I very, very highly disencourage anybody to use a target date fund unless they really truly know what they're doing and they feel like that's a good fit for them. But most people don't pick a target date fund. They are opted into a target date fund because they just haven't done the due diligence of checking what it's in. So you have to select your investments, especially in a 401k. That is not just a 401k, that is the account. The 401k is the account. You have to select the investment, which is the next bullet point. So investment fund. So this is the most important piece of this entire equation, in my opinion. Well, not the most important piece. The most critical point of this whole conversation, which kind of leads into the investment conversation from the original question, what should I invest in? Remember, think how long I've talked, okay? So if somebody sends me a DM and they say, what should I invest in? How am I going to explain this all in a DM? Do I waste 30 minutes of my day for every person that asks that? There's not a chance in this world, which is why I have this Whiteboard Wednesday tonight. And why I put other topics together every single Wednesday for you guys, so we go into depth on these conversations. So number 3 is investment fund, okay? So investment fund, we want to look over here. This is portfolio allocation. You might hear that terminology thrown around. I want your, what's your allocation? What's, all the nerds say it, right? This is portfolio allocation. This is where the investment fund or the actual investment starts to come into play within these accounts. So this is within these accounts. This is within this is within this, and this is within that, okay? And so now we're within the broker. Let's say we're working with Vanguard, and we have an IRA, a Roth IRA, that's the account type. And now we have to go into the investment fund level and select maybe some investments, okay? So maybe it's an ETF, an exchange traded fund. Excellent choice. Most being passive and excellent choice. A mutual fund. Mutual fund twice I have here, right? Active and passive. So an actively managed mutual fund has high fees. I am not a big fan of them. I would stay away from them. That's just my personal opinion. You can go research why fees suck in the investment world, but I stay away from those for various reasons because typically they're going to provide suboptimal performance on a net basis. And then you also have mutual funds on a passive level, which are index funds. When you're thinking index funds. When I talk about index funds and ETFs, it's these two guys all the time, but not this middle guy. So within those are the actual investment funds, okay? And so those have asset classes. So now we got to go down one more level. So with an ETF, there's various ETFs, there's various mutual funds, there's various index funds. What type of fund are we looking for? Is it a cash and cash equivalent, like a money market fund? Is it a stock fund, like a VTSAX? Is it a bond fund, like a VBTLX? Maybe a commodity fund, like oil, silver, gas, all those kind of commodities. Maybe REITs, real estate investment trust. So we have to select what type of asset class. That's typically outlined in the prospectus, or you'll see that in the prospectus or fund fact sheet for the various funds that you have here that you select. So an example of the mutual fund passive would be like VTSAX, right? VTSAX. That would be like an example. That's what I talk about a lot. That's one of my biggest holdings I have personally. And that would be an example. And that would fall under this bucket, which is the stocks, okay? So that's a stock. That's my actual investment fund. But technically, to understand what an investment fund is, we have to understand what the core investment is, which is what I get into. So most people, when I say what should I invest in, we'll kind of stop there from an investment fund level perspective, because that's typically where we talk about this is the actual investment you're selecting. Like you're actually going into your account within Vanguard in your IRA and saying, hey, I want, whatever, it's 80% VTSAX and then 20% whatever else you want, okay? So that's typically where the conversation ends, but to take it another level is we have to understand what an index fund, what a mutual fund, what an ETF is. They're going to vary to different degrees. I have it in my book. I'm not going to waste my time talking about this, of what the differences are. The individual companies are what you are buying within. So this is a big collective group of a basket, right? So you have a big basket right here, and that basket has Apple in it, that has Tesla in it, that has whatever you want in it, right? It's your decision that you get to make. However, there's a stylistic approach to stocks, and based on the type of index fund is the type of stocks that you'll get. So in a nutshell, very high level again, is you have large cap, you have mid cap, you have small cap, the size of the company, right? From a market cap perspective. And then you also have maybe growth and value, the stylistic approach. So if you look at this stylistic approach box, you'll see this on Morningstar, okay? And basically the riskier is to the right, and the more riskier is down to the bottom. So this is like this bottom quadrant is the riskiest piece of this entire equation. So that means if you have a small cap growth, they kind of meet, obviously. A small cap growth would be the most risky type of stock on this chart per se, based on the level of risk that it says. While a large cap value would be the least risky, right? And it makes sense from to understand it from that perspective, okay? On top of that, you have 11 sectors in the stock market in general, right? You might have like technology, healthcare, all those kind of sectors. Consumer discretionary. And so within these ETFs, index funds, and mutual funds, you're going to have different types of stock choices. So it could be collectively like, a blend, large cap blend. But you will see, like on the Vanguard site, they'll show you kind of what box this falls in, or which fund the box falls in. And so you can tell by the level of risk what level of risk you're taking on by looking at this approach as well. And then honestly, if you have an ETF or something like a VGT, for example, a VHT, which is healthcare and technology sectors, that's in healthcare technology sector ETF, and you can have that as well. But if you have a total market, you already have 11 sectors, right? So you're basically picking one out and saying, I want to enhance the exposure to a specific sector because of X, Y, and Z. Hopefully you're providing reasoning, not listening to somebody on the internet, and you've decided that investment choice for you. Okay, so the actual investment you're making is you're buying Apple. You buy a portion. So let's say from a practical perspective, let's put this into context, okay? I go to Vanguard.com. I go in there and I say, I want to open a Roth IRA. I go select a VTSAX. I throw $500 in VTSAX, okay? And I throw, let's say VTIAX, let's say the other one, let's put 20%. So international and US. So I have all of US stocks of my $500, 80% or $400 goes to all US stocks within this fund, which would be roughly 3,500 different individual companies. Each one of those companies within that fund, there's a percentage that they make up. So let's say Apple makes up 5% of the entire piece of that pie, right? 5% of your $400 will go straight to that company, technically speaking, right? You're investing into the individual company, technically. And then on the flip side, your other $100 goes to the 20% VTX. All of the companies in there, they have a split percentage between each one of them, right? Depending on how big they are, is the percentage that the $100 will go to each percentage accordingly, collectively to the whole entire fund as a whole. There's obviously, you can do split funds and all that kind of stuff, or not split funds, but you can do fractional shares as well for some of these and all that kind of good stuff. But this is a massive problem, guys, that people are just blindly asking for advice and asking for a stock pick, a hot pick or whatever, and they aren't understanding that there's actually levels to this, and there's a lot that goes behind it because, again, back up to the broker can have some fees. The account type could be a total disaster if you don't plan appropriately. Even myself, guys, I teach this for a living. I do this for a living, and I will absolutely have a second set of eyes, and I will pay a steep fee to make sure my account types are in line with my goals and my tax diversification strategy is good, and I will not wait until 50, 60, 70 to do that because it's going to be too late. I will pay somebody right now, me, somebody that talks about this every single day, because I like to have a second opinion no matter what I know, no matter what I say. It's always good no matter who you are because you could easily be overlooking something, so it's a double check, a double set of eyes. So even if you know what you're doing or you think you know what you're doing, it's also wise to pay a professional, pay a strategist to get you to the right place or at least double check. It's like a CPA with your taxes. If you do your taxes, you probably know what you're doing on a basic 1040 level, but there might be some benefit of maybe doing a double check, a due diligence, because maybe he finds something that you had no idea or you just totally missed or overlooked. And that could be a huge mistake that's 6 or 7 figures. So I'm going to pay that professional $1,000, $500, whatever it costs to meet with them and make sure that this is in line because it's going to cost me 6 or 7 figures down the road and it's not worth my time or money at that point in time. And you operate like that and you'll win big time. So guys, this is a good snapshot of kind of like what should I invest in. So every time somebody asks me this, and they'll be hearing this because obviously I'm going to send this out to DMs when I get this question. They're going to get this entire presentation. So I hope this kind of makes sense as to why I can't answer this directly. I wish I could. I think all of us, the people online that do this for a living, wish we could do this, but we can't. Some, I guess, try to, do it and they give out stock picks, but that's another story. So be very careful if anybody does that, guys, but I hope this gets you to your answer and explains from a high level. But if you ultimately maximize your tax diversification strategy with your portfolio allocation, you are going to get amazing returns, amazing goals that all your goals are going to be hit. Every goal that you have lined up is going to be hit on the dot plus some, but you have to optimize that in this to ultimately have good results long term. All right, guys, I'm going to flip it around and answer questions, and I have until 8:30. Like I said, I'm in my room, so I have my dogs laying here right here. And we're moving right now, so we have like zero... we have like nothing in our house and everything's a mess right now because we're moving in like we're moving very, very soon. Okay. All right. All right. This is why it's really hard to be a creator. I just explained a 30-minute presentation on everything, and I get a comment saying more on account type. Guys, I can't handle it. I can't handle it. I'm sorry. I do everything I can, but sometimes I just can't. I don't know what people see when they see, but I have it all out there, I promise. All right, so I'm going to answer questions, guys, real fast, and then I'm going to probably pop off. I'm going to scroll through these. I just opened a Vanguard account and started investing in VU. Phenomenal. So that's the ETF. You had the account type. You had the broker, the account type, and you had the investment fund, which is the ETF, which is the S&P 500. Phenomenal. Looks good, Coach. What's up, Anna? Gold. Yeah, gold would be like a commodity. It would fall under a commodity. If you're asking me if you should invest in that, I have no idea. Again, you have to come to your own conclusions. Yeah, my current home has been sold. And guys, for somebody asked me about commodities as well, is I have a whole whiteboard Wednesday on how to get portfolio allocation. So the topic we talked about right here, allocation, we have an entire whiteboard Wednesday on how to break down the allocation in detail, which is why I did not get into that as well tonight. I'm going to scroll through that, guys. Sorry, I'm rushing because I have a presentation for Wealth Squad at 8:27. IULs suck. Sabiga was, I don't know what your name is. I have a whiteboard Wednesday to destroy your argument on that as well. So IULs are horrible, and can you tell I'm feeling a little spicy today? IULs are sold to 100% of people, and they're the most unethical product out there. I don't feel bad about saying that either because it's bad business. About to pull all my money from Robinhood. Yeah, Robinhood's not the greatest. There's a lot of backstory behind that, but okay, guys, I'm scrolling through very, very, very fast. I'm getting there. TD Ameritrade's fine. It's just trading. I just wouldn't use it for investments because it's more for trading. It's just meant for that. What are my options as a self-employed barber? You could do a solo 401k. You could also do a SEP IRA would be excellent options, man. You could also do obviously everything else, but from an employer perspective, since you're self-employed, like I'm self-employed technically, I'm my only employee. I 1099 everybody else, so I use a solo 401k myself. Long story short, learn taxes and diversify. Yes, 100%, guys. This would literally change your life like six figures. It will if you don't have this right. So again, meet with a CPA, meet with whoever you need to meet with, but please do that. Don't wait. What was the healthcare fund? Healthcare fund is VHT, Melissa. That would be ETF through Vanguard, which is healthcare specific. Okay, I'm gonna answer one. What's up, Kirk? Got some VCILX yesterday. Amazing. Anna, yes. VCILX, guys, is international through Fidelity. Phenomenal. Prudential, through my job. Yep. Every 401k is different, guys. The broker obviously is one part of it, but you also have the investment options within that. I don't know. They're going to change from plan to plan. Like I said in the beginning, your employer will go purchase a group of funds. Those funds could be bad. They could be good, depending on the broker they use, also how much they pay that broker, all those kind of things. Typically, the bigger company, the bigger the company is, the more they spend on the plan, the better it is. I'm 31 years old, almost 31. I'm 30 right now. I'm going to turn 31 on the 27th. Is Roth better if we're high earners? There's a lot. That's an open-ended question again. I talk about, go watch my whiteboard Wednesday and Roth or traditional and how portfolio allocation, all that stuff. All right, guys, I got to run. I have a whiteboard presentation or another presentation at 8:30. I got to switch into, so I appreciate everybody. Send me any questions you guys have on this, and this will be saved as well on my page.